This is the High Voltage Business Builders Podcast, daily intelligence for serious e-commerce portfolio builders across Amazon, TikTok Shop, Shopify, Walmart, and every channel that moves the needle. Neil Twa and his team, all day, every day since 2012. Let's get into it.
Effective May 1st, 2022, Amazon introduced a 3.5% fuel and inflation surcharge on all U.S. and Canadian FBA fulfillment fees. For the uninitiated, this might seem like a minor adjustment. For portfolio operators managing multiple branded assets, this is a significant compounding operational cost, impacting every single unit shipped. Consider a portfolio generating $10 million in annual FBA sales with a 25% fulfillment cost ratio. This 3.5% surcharge translates to an immediate $8,750 quarterly hit to your bottom line, or $35,000 annually per brand. Multiply that across a diversified portfolio of 5 such brands, and you're looking at a $175,000 annual reduction in net operating income, directly impacting your asset's valuation and potential exit multiple. This isn't theoretical. It's a direct transfer of inflationary pressure from Amazon's balance sheet to yours. The market has already seen FBA fees increase by an average of 5.2% in 2022, prior to the surcharge. This new layer further compresses margins, making operational efficiency and strategic pricing more critical than ever. The question isn't if your portfolio will feel this, but how quickly you can adapt to mitigate the impact, and more importantly, how you can leverage this disruption to gain a competitive advantage. How will you recalibrate your assets' financial models to absorb this new reality while maintaining or even improving your ROI? This 3.5% FBA surcharge is Amazon's strategic response to unprecedented macroeconomic pressures, specifically escalating fuel costs and labor inflation. By structuring it as a temporary surcharge rather than a permanent fee increase, Amazon retains flexibility. They can remove it if conditions improve, or, more likely, integrate it into a future higher base fee structure, effectively testing the market's elasticity. For the sophisticated operator, this isn't just a cost. It's a data point revealing Amazon's operational leverage and their willingness to pass through expenses directly. The impact on your portfolio is not linear. For a brand asset with a 20% net profit margin, a 3.5% increase in fulfillment costs, assuming fulfillment is 25% of COGS, translates to a 0.875 percentage point reduction in your overall net margin. This effectively erodes 4.375% of your net profit. On a $5 million brand, that's $43,750 directly off your bottom line. This directly impacts your EBITDA, which is the primary driver of your asset's valuation multiple. A reduction in EBITDA by even a few percentage points can shave hundreds of thousands, if not millions, off a potential exit valuation. This move disproportionately affects lower margin products and portfolios heavily reliant on Amazon FBA, forcing a critical reevaluation of product mix, pricing strategy, and channel diversification to protect capital and maintain asset value. Voltage caliber operators don't just react to these market shifts, they anticipate and weaponize them. Consider the case of Project Atlas, a portfolio holding in the outdoor adventure niche, generating $7.8 million annually on Amazon FBA. When the surcharge was announced, the initial projection was a $68,000 annual hit to their EBITDA. Instead of absorbing it, the operator, a former private equity associate, immediately initiated a two-pronged strategy. First, they conducted a granular SKU-level profitability analysis, identifying the bottom 10% of products that would become unprofitable or marginally profitable post-surcharge. These were either phased out or moved to a hybrid FBM model for specific geographies. Second, they implemented a strategic price adjustment of 2.5% across their top 20% of SKUs, which accounted for 80% of their revenue. This wasn't a blanket increase, it was data-driven, targeting products with high demand elasticity and strong brand equity. The outcome? Not only did they fully offset the $68,000 surcharge, but the portfolio asset saw an additional 1.2% increase in net margin, translating to an extra $93,600 in EBITDA. This improved their projected exit multiple by a conservative 0.5x, adding nearly $400,000 to the asset's valuation. This is not luck. This is what 13 years of operator-led infrastructure looks like in a down market. To navigate this new operational landscape and protect your brand assets, here are 3 immediate actionable steps for your portfolio. First, conduct a comprehensive SKU-level profitability audit.
Utilize tools like Sellerboard or Helium-10 to model the exact impact of the 3.5% surcharge on every single product in your FBA catalog. Identify your zombie SKUs that are now unprofitable or barely breaking even. This data-driven approach allows you to make informed decisions about repricing, bundling, or even liquidating underperforming inventory to free up capital. Second, strategically reevaluate your pricing architecture. Don't implement a blanket price increase. Instead, identify your top 20% of revenue-generating products and assess their price elasticity. A 2 to 3% price adjustment on these high-demand items, communicated effectively through enhanced value propositions, can often offset the surcharge without significant sales volume impact. For lower-performing SKUs, consider optimizing packaging or exploring alternative fulfillment methods like FBM for specific regions or product types. Third, diversify your fulfillment strategy. While FBA offers unparalleled speed, a complete reliance exposes you to Amazon's unilateral fee adjustments. Investigate a hybrid FBM model for specific product lines, or explore 3PL partnerships for a portion of your inventory. This mitigates risk and provides leverage in future negotiations, protecting your portfolio's long-term ROI.
The landscape of e-commerce is constantly shifting, and the 3.5% FBA surcharge is a stark reminder that proactive, operator-led strategy is paramount for protecting and growing your brand assets. This isn't about chasing fleeting trends. It's about building resilient, sellable businesses that generate predictable returns for your investment portfolio. At the High Voltage Business Builders podcast, our 13-year track record is built on guiding sophisticated operators like you through these complexities, transforming challenges into strategic advantages. We understand that you operate at a different level, demanding insights that directly impact your EBITDA and exit multiples. That's precisely why we've created the 7-Figure Blueprint Workshop. This isn't a theoretical exercise. It's a live, interactive session where I, Neil, will personally walk you through the exact 8-figure mind map I've used to build and scale multiple branded assets to an 8-figure valuation. You'll gain direct access to my strategies for navigating market disruptions, optimizing profitability, and enhancing your brand's asset value. The total value of this workshop, including the mind map and live Q&A, is $1,235. However, for a limited time, you can secure your seat for just $97. Our last 18 workshops sold out completely, and seats are extremely limited. Don't miss this opportunity to fortify your portfolio with battle-tested strategies. Visit voltagedm.com/workshop to reserve your spot. Build smarter, not harder.
That's a wrap on today's episode. If something we covered today sparked an idea or made you wonder where you actually fit in the e-commerce landscape, there's a good place to start. Head over to voltagedm.com/discover. Answer a few questions, and we'll point you toward the right path for where you are right now. We'll be back tomorrow with another edge. Until then, stay high voltage.